So hello guys, we are going to discuss today CVP analysis. It is also called break-even analysis. So I'll explain what it is. So let me quickly tell you, in CMA part 2, this domain is called decision analysis. And this domain includes these 3 chapters. So it is about CVP analysis. Then we have another chapter, marginal analysis. And third chapter, we have pricing analysis. So these 3 units are called decision analysis, and it is going to be your 25% of your CMA part 2 exam. So here we go, starting with CVP analysis, cost, volume, profit analysis. It is the first lecture on CVP analysis. So let me tell you guys. So there are 3 words. Quickly, let me explain. So C stand for here cost. V stand for here volume. It could be a production volume or it could be sales volume. Okay, so because here we will assume production equals to sales, I'll explain the assumption of the topic also. And then P stand for profit. So in simple words, CVP analysis means a cost analysis, volume analysis, profit analysis. Okay, so like these are 3 variables, you can say. Okay, so if one variable will change, what would be the effect on other 2 variables? For example, let's assume if you will increase the production, just give you example, which is called volume, or if you will increase the production or sales, what will be the effect on cost or what will be the effect on profit? Another way, for example, if you will increase the cost, let's assume, what will be the effect on volume? What will be the effect on profit? Or if you will decrease the cost, what will be the effect on volume? What will be the effect on profit? So for example, another way, let's assume if you want to increase your profit, what production volume you have to achieve and what the cost you will incur. So this is what is called CVP analysis. It means this is the study of 3 variables. If there is a change in one variable, what will be the change in other variable? So here we, in this topic, so I'll explain what it is, which this CVP analysis is also called break-even analysis. So there we will move what is break-even, how to calculate it. So let me just quickly guide you. So in this topic, we will study these 3 topics. So we have a cost, volume, profit analysis. We'll talk about overview. Then we here in this topic, we will talk about how to calculate main 2 things, how to calculate break-even point, how to calculate margin of safety, these things. And then we have other topic. This is also relevant to CVP analysis. There we will talk about something about target income. Okay, and then third topic is there. So in which we will talk about how to calculate break-even point and other things, but relevant to multi-products. So first 2 topics are relevant to single product. Like what if you are manufacturing and selling single product? So then we will talk about multi-product. So I'm starting from here first, the overview. So before moving to the topic, guys, so very first thing, I want to explain the assumptions of CVP analysis. CVP analysis, as I told you, it is also called break-even analysis. So what is the first assumption here? Because based on this assumption, so we will understand the topic. First assumption is that cost and revenue relationships are predictable and linear. Like simply, you can predict the sales for the future. You can also predict the cost for the future. But this cost and revenue relationship is predictable. Okay, for example, if you want to increase your revenue, what will be in the increase in cost? If your revenue is going to decline, so what will be the reduction in cost, right? So this is called a linear relationship. Linear relationship means when one variable increases, what will be the effect on other variable? Obviously, other variable should also increase. If one variable decreases, other variable will also decrease. So here what we assume, the first assumption is that the cost and revenue relationship are predictable and it is linear. Understood? And please also remember, we also assume these relationships are true over the relevant range of activity and specified time span. So let me explain this word also. What does mean by relevant range? There is a concept. So this concept we studied in the part 1 also. So let me quickly repeat what this concept is. So actually relevant range means say it is the time frame. Okay, you can say it is the time span over which these things will happen. What will happen? So one thing is relevant to variable cost, and second thing is relevant to fixed cost. So if variable cost, this is the cost, obviously, which will change with the production. Like when your production will increase, obviously variable cost will also increase. But which variable cost? So variable cost, guys, here we have two types of variable cost. One is called per unit variable cost, per unit variable cost, and second is called total variable cost. And same way, we have a fixed cost. We know the definition of fixed cost. Like usually this is the cost which will not fluctuate with the production. But which fixed cost we are talking about? Again, here we need to understand two things. We need to know per unit fixed cost, and we need to know fixed cost in total. So total fixed cost. Because I am explaining actually the relevant range concept here. First, let's understand quickly, guys, what we assume. We always assume that whenever your production increases, your total variable cost will also increases. And whenever your production decreases, so your total variable cost will also decreases. It means here your total variable cost has direct relationship with the production. Whenever production increases, total variable cost will also increase. Whenever production decreases, total variable cost will also decrease. But what is the assumption about per unit variable cost? Per unit, it's also called unit variable cost. So what we assume? We always assume that unit variable cost will remain constant, but for the short period of time. For example, material cost is your variable cost. Okay, like material cost, we can assume maybe it will be constant, but for the short period of time. Okay, so it means, so if you will link with the production here, okay, so what we can say, variable per unit cost will remain constant. Even your production will increase or your production will decrease, it will remain constant, but again in the short time period. Then we have a 2 points relevant to fixed cost also. Per unit fixed cost, what we assume, whenever your production increases, so per unit fixed cost will decrease. And whenever your production decreases, per unit fixed cost will increase. For example, your rent. Let's assume rent is your fixed cost. Okay, let's assume rent is 1,000. So if you will divide this rent with the output, for example, if output is 1,000, so per unit rent, per unit fixed cost will be $1. What if your output is going to be 2,000? So what will happen here? Per unit fixed cost will be what? 0.5, right or wrong? So this is what is happening. So whenever production increases, per unit variable cost decreases. Whenever production decreases, per unit variable cost, whenever production increases, per unit fixed cost decreases, its fixed cost. And whenever production decreases, per unit fixed cost increases. It means here fixed cost per unit has indirect relation with the production. And what about total fixed cost? For example, even you will produce more units or less units, so your rent for the factory space is not going to change, but this rent is going to be constant only for a short time period, maybe 1 year. Okay, after 1 year, maybe rent will increase, right? So then what is the concept of relevant range? Now I'm going to tell you. Actually, relevant range is the time span. It is the time span in which per unit variable cost will remain constant and fixed cost in total, it will remain constant. So that time frame, again, I'm saying it is the time span, okay, in which unit variable cost is going to remain constant. Unit variable cost means a per unit variable cost, and total fixed cost is going to remain constant. That is called relevant range. And mostly it is short period of time. So we can assume it could be 6 months or 1 year. So it depends actually on nature of business in business you are. Okay. Then, so this is the first point. What was the first point? We assume cost and revenue relationships are predictable and linear, but these relationships are true over the relevant range of activity only. Maybe in the long term, it will not be true, but in the short run, it will be true. Like it is the time span in which your unit variable cost and fixed cost in total will remain constant. What is the second assumption? Okay, second assumption is that we always assume unit selling price do not change. It will also remain constant. Unit selling price means the sale price of the unit. It is not going to change because we are going to calculate break-even point. Obviously, for that, we need to assume certain things. So what is this we are assuming here? We are also assuming that your unit sale price will not change. Third is what we also assume, inventory level do not change. Here we always assume that your production equals sales. For example, whatever units you will produce, all those units will be sold. Understood? So your production will be equal to sale here. It means we do not have here closing inventories kind of things. Okay. So inventory level is not going to change. Next is what this I already told you about the variable cost. So total variable cost, because variable cost, there are two types, total and per unit. Total variable cost will change proportionally. So total variable cost means when your production will increase, total variable cost will also increase. When you will cut the production, total variable cost will also decrease. But I told you about unit variable cost, like per unit variable cost, I told you per unit variable cost do not change. It is not going to change. Okay, it will remain constant, but over the relevant range. Then I told you about the fixed cost also. I told you 2 points that fixed cost in total, like total fixed cost remain constant over the relevant range. But unit fixed cost, per unit fixed cost, it it can vary indirectly with the volume. As I told you, if you will increase the production, per unit fixed cost will decrease. It has indirect relation, okay, with the production. If you will decrease the production, per unit fixed cost will increase. Then what we have here, next exemption is about the revenue and sale mix does not change. Actually, this point we will understand once I will teach you about multiple product, okay, like how to calculate break-even point. So there we will understand this. So far, ignore this point. And next is what time value of money is ignored. So we are not going to calculate anything. We are not going to calculate any present value, although this decision is for the future, but still we are not going to calculate any present values here. So that is why time value of money is ignored. For the sake of theoretical question, you should remember these points, okay, because questions could be theoretical also. Now, again, we have a one more definition we need to understand. So I'm going to explain here about the contribution margin. Okay, because in CVP analysis, what idea we are going to apply? We are going to apply a marginal costing approach. Marginal costing is also called variable costing. So whatever format we follow usually to calculate operating income by applying variable costing, like in simple words. So we produce income statement by using variable costing. So same concept we are going to follow here. So because variable costing can be used for internal decision making. So we are not going to use here absorption costing and or any other costing. So we are going to apply variable costing approach. Okay. So then guys, what we have here, so I'm going to explain now few terminologies. This theory will be covered with the help of examples. So here we go. Let me tell you how we produce income statement by using variable costing, which is also called marginal costing. So this is a small example for that. And here I will explain certain terminologies and certain definitions with the help of this example. So for example, we have your company X sells 10,000 units. This is unit sales units, okay, at a sales price of 40 per unit. This is the selling price. Variable expense, you can say variable cost, are $12 per unit, okay, and the fixed cost in total is how much? 200,000. So if this data is in front of you and you want to produce income statement in short by applying variable costings, how would you prepare it? So this is how we can prepare. So first of all, we will write the value of sales. Sales, how you will calculate? We'll take number of units sold, which are 10,000 here, multiply by selling price, which is $40 here. So if you will multiply, you will get the value of sales. From there, you will deduct here variable cost. We'll deduct variable cost, variable expenses. So how we can calculate variable expenses? So we'll take again unit produced or unit sales. The reason is that production is equal to sales. So I'll take unit produced or unit sales, multiply by variable cost. Variable cost is given at 12 per unit. So this is going to give you variable cost of $120,000. Then if you will take sales less variable cost, so this is going to give you contribution margin. Okay, actually by definition, what is contribution? Contribution mean to say it is the profit which we can use to cover our fixed cost. But how it is calculated? So we always take sales less all variable cost. So this is how we get contribution margin. So from sales, once we will deduct contribution margin, once we'll deduct variable expenses, so you are going to get contribution margin. From contribution margin, we'll deduct our fixed cost. Okay, so fixed cost unit may include rent, depreciation, even insurance. Okay, depreciation is also the part of fixed expenses. Okay, so we'll deduct from here. Okay, let's assume I'm assuming fixed expenses at 200,000 as it is given in the question here. So this is going to give you operating income. This is how usually we prepare income statement by using variable costing. But here we go now. So then what is the break-even point? Okay, so first let me tell you here about the break-even point definition. Okay, or else let me explain first other terminologies, then we'll move to the break-even point. So first let me tell you here, because these concepts are going to be applied, are going to be used in your break-even analysis. So first word you should remember, what is unit contribution margin? Okay, please remember, unit contribution margin in shortcut, it is also called UCM. So it is also called contribution margin per unit, or it is also called contribution per unit. Okay, contribution per unit or unit contribution margin, it is the same thing. Okay, don't confuse with this terminology. How you can calculate contribution per unit? So there are two ways we can apply. First way is what? I can take, because I want to calculate contribution per unit. The first way is that I can take my total contribution. Okay, total contribution. I can divide with the total number of units. Number of units are how much? 10,000. So this will give you $28 per unit. This is the first way which is explained here. Okay, we can take 280,000, which is your total contribution margin. You can divide with that units, number of units, because number of units sales sold, you can say, are number of unit produced, you can say, because sales is equal to production. So if you will take total contribution divided by total units, so you will get what? Unit contribution margin. It's a contribution margin per unit. There is another way we can also get by using another way. So what is the other way? So I can take unit selling price, sales price per unit, and from there I can deduct variable expense per unit. So unit selling price is $40 and variable cost per unit is $12. So 40 minus 12, it is also again $28, which is going to be your unit contribution margin. So as I told you, so we can use total contribution divided by total units, or we can take sales price per unit minus variable expense per unit. So you can get what? Unit contribution margin. Understood? Then we have here another terminology that is called total contribution, because total contribution you can also, you need some time, okay, to get it. So how we can find out total contribution? Total contribution first way is what? The first way, if you look at this income statement, so I can calculate, first way is to calculate the total contribution is what? I can take total sales, this is total sales, which I got 10,000 units times 40, 400,000. From there, I can deduct total cost, total variable cost, variable, which is 120,000. So 280,000 is called your total contribution. This is the first way. Like take total sales value minus total variable cost, you will get total contribution margin. There is another way to get total contribution. Other way is what? I can take unit contribution margin multiply by number of units. So this will also give you total contribution. Total unit contribution margin, how you can calculate? We know unit contribution margin is equal to sales price minus, which is 40, minus variable cost, which is 12. So unit contribution margin is 28. This 28, if I will multiply with the number of units sold, you can use the word. Number of units produced, you can use the word. So number of units are 10,000 in the question, which is here. Again, you can find what? 280,000 as total contribution margin. Okay, so this is the way to get total contribution margin. Then there is another word we need to understand that is called contribution margin ratio, CMR. Contribution margin ratio is what? Actually, it is the contribution in percentage, but of sale, like contribution margin in percentage of sale value. Okay, like if you will convert the contribution into percentage, Okay, but you will take contribution divided by sales. So if you will apply this formula, you will get contribution margin ratio. So here we go again. We have a two ways. I'm explaining the way. So how you will calculate contribution margin ratio. It is the ratio of contribution to sale. So what we'll do, the first way is, so we can use the totals. Use total means what? I can take total contribution margin, which was in my example 280,000, and I can divide with the total sales. A total sale in my income statement is 400,000, and I can multiply with the 100 to get the contribution margin ratio. It is going to be 70%. So what it means? It means your contribution is 70% of sale value. This is called contribution margin ratio. So I can also calculate the same percentage by using per unit data. Here I have used total data in totals, but I can use per unit data also. How? I can take unit contribution margin. Unit contribution margin, do you remember? It was selling price minus variable cost. Selling price per unit minus variable cost per unit. So it was $28 in my example. So I can take unit contribution margin divided by selling price per unit, which is sales price per unit, which is $40. So, and I can multiply with 100 to get into the percentage. So 28 divided by 40. So again, it is 70%. So it is called your contribution margin ratio. Understood? So far what we have learned, we talked about how to find out unit contribution margin, how to find out total contribution margin, how to find out contribution margin ratio. I have explained these things. Now, guys, we are moving to the break-even point. Now I'll explain what is a break-even point. So here we go. First, if I'll take you back to this income statement from where we started. So here it is easy to understand break-even point. So what's the definition of that? So guys, here we go. Please remember here. So I can define the break-even point in two different ways. First way is what? First, remember what is break-even point. Break-even point is the point at which you will not have a profit and you will also not have a loss. So there is no profit and no loss. This position is called break-even point. Understood? So because there are three scenarios, maybe you may have profits, you may have loss, or you may have no profit, no loss situation. So the situation in which you don't have a profit or loss, that is called break-even point. And by definition, break-even point, how it is explained. So break-even point, if you look at this income statement, we got a sale here, we got a variable cost, we got a contribution margin, we got here fixed cost. This is your operating income. So break-even point will be the point at which your operating income will be zero. This value will be zero. And how it could be zero? There are two possible scenarios. Number one, the first scenario, if your total contribution, which is 280,000, if it will be equal to total fixed cost, if total contribution margin, it is equal to total cost. It is equal to fixed cost. If it is equal to total fixed cost, okay? Total fixed cost. Again, here, what will be the situation of profit and loss? Profit and loss will be zero. For example, I'm saying my total contribution is 280,000 and my total fixed cost is also 280,000. So total contribution 280. If I'll deduct total fixed cost, which is also 280, so I will have zero profit, zero loss. This is the first definition. Like how you will define break-even point? It is a point where total contribution equals the total fixed cost. There is another way to define break-even point. So other way is what? If my sales is equal to total cost. Total cost means what? It should include total variable cost and total fixed cost. For example, I'm saying my sale, I'm just assuming my sale is, for example, 200,000. My fixed cost, variable cost is, for example, 100,000. And my fixed cost is also 100,000. It means my total cost is 200,000. If I take sales, which is 200,000, and total cost is also 200,000, again, the profit and loss will be zero. Right or wrong? So these are two definitions of break-even point. First definition is what? Where your total contribution equals total fixed cost. That is the point where you will not have a profit or loss. Second one is what if your sales, with I mean so revenue, is equal to total cost. Total cost means it should include variable and fixed. If sale equals total cost, again you will have no profit, no loss, and that point is called break-even point. Okay, so here we go. If you look at here, now I'm moving here. So these 2 points I have explained. Okay, these 2 points actually I have explained. Now you can go through. Now, the point is that how break-even point is calculated. Okay, please remember it is based on the assumptions, right? We studied the assumption. We assumed that unit variable cost will not change. Okay, and we also assumed total variable cost will directly change with the production. We assumed that fixed cost per unit has indirect relation with the production, and total fixed cost will remain unchanged. We also assume production is equal sales. We also assume selling price will not change. So these are a couple of assumptions are there. Okay, based on assumptions, how do you calculate break-even point now? Okay, so there are two formulas which we can apply to calculate break-even point. The first formula is if you want to calculate break-even point in units. Please remember. And second formula is if you want to calculate break-even point in dollars. Dollars of what? Dollars of revenue. Sales dollar. Okay. For example, break-even point in units mean to say how many number of units I have to sell to arrive at break-even point. But break-even point in dollar mean to say break-even point in dollar means say what should be the value of sale which would leave no profit, no loss for me. Okay, these two things are different. First formula would give you answer in units. Second formula would give you answer in dollars. Okay, so if you want to calculate break-even point in units, so what formula you will apply? You will take fixed cost in total. Total fixed cost you have to take. Please don't take per unit fixed cost. Total fixed cost we have to take, and we'll divide with the unit contribution margin. Unit contribution margin, I told you how you will get. You will take selling price per unit minus variable cost per unit. Okay, this is the one way. And other way, I also told you how to get unit contribution margin. Okay, so if you will apply this formula, fixed cost divided by unit contribution margin, so you would get what break-even points in unit. Then, guys, if you want to calculate break-even points in dollar, so you have to take fixed cost divided by contribution margin ratio. I told you how to get contribution margin ratio. I'm writing one formula, but I told you two ways there. Contribution margin ratio means we'll take unit contribution margin divided by unit selling price and multiply by 100. So this will give you contribution margin ratio. Okay, you can also calculate by using total contribution and total sale price. Okay, you can also calculate contribution margin ratio by taking unit contribution margin divided by unit selling price. Okay, so this will give you break-even point in dollar. How you will take fixed cost divided by contribution margin ratio. So this will give you break-even point in sales dollar. Okay, now let's have a look how it is going to work. So we will apply through the first example, then I'll show you exam standard question, and from those questions you will get idea actually. Okay, so how to work with that question. So here we go. Here we have a small example first. For example, a manufacturer's product has unit sales price $0.6. It is per unit selling price. And unit variable cost is $0.2. Okay, so we have a fixed cost. Fixed cost are $10,000. This is total fixed cost. So for example, I want to calculate break-even point in units, and I want to calculate break-even point in dollars. So if I want to calculate break-even point in units, I have to apply this formula, fixed cost, which is $10,000 given here, divided by unit contribution margin. Okay, unit contribution margin I can calculate. How? I'll take unit selling price, which is $0.6, minus unit variable cost, which is $0.2 given here. So this will give you unit contribution margin 0.4. If I take fixed cost, which is 10,000, divided by unit contribution margin, which is $0.4. So this will give you answer of 25,000 units. So it means if you would sell 25,000 units, okay, so you will exactly arrive at break-even point, but along with those assumptions. Okay, if those assumptions are true, obviously you will arrive at break-even point. Clear? So let's, if you want to prove this, you can prove it very easily. For example, by using this data, this much number of units, I can produce small income statement. And if I'll produce the income statement, I'll exactly get zero profit, zero loss. For example, first I'll write sale. Sale, how I will write? I'll take 25,000 units into selling price is 0.6. I'll get the value of sale. You can do on your calculator. I'm showing just format. So from there, you will deduct variable cost. Okay, variable cost, again, you will take 25,000 units into variable cost is how much? 0.2. So this will give you variable cost. If you will deduct from sales, you will deduct the variable cost. This will give you total contribution margin. Okay, here you will get total contribution margin. And from there, if you will deduct fixed cost, which is given in the question 10,000. Okay, so exactly here you will get what? Profit or loss, you will get zero. You can just try this value on your calculator, 25,000 into 0.6, then 25,000 into 0.2, deduct from sales, you will get total contribution, and then deduct fixed cost. This will leave a profit or loss, zero value. Okay. Then if you want to calculate now, break-even point in dollar, okay, in dollars, how you can calculate? You will apply the formula. You will take fixed cost divided by contribution margin ratio. So fixed cost, we know it is 10,000 given in the question, but this you need to calculate now, contribution margin ratio. And how I can calculate? I can take unit contribution margin divided by unit selling price multiplied by 100. Unit contribution margin is 0.4, we calculated here. And unit selling price is given here 0.6. And multiply by 100. If you will multiply with 100, you will get 66.667% as contribution margin ratio. So this contribution margin ratio, I will divide here. Okay, I'll take fixed cost, which is 10,000, and I'll divide this contribution margin ratio with the fixed cost. Fixed cost divided by contribution margin ratio. Obviously, if I'll remove the percentage of this value, it is equal to 0.66667. If I divide, I'll get break-even point in dollar 15,000. And you know, guys, this 15,000 like will be the same value which you got it here. 25,000 units into 0.6. Even you can try on your calculator. So it would be exactly 15,000. Okay, anyway you can use. So let me just calculate on calculator. So if you will take 25,000, this I'm multiplying just, times 0.6, it is exactly 15,000. And this 15,000, you can got this way directly also. Okay, by calculating unit contribution, break-even point in sales revenue. Is that clear? I hope so it is clear. Now, let's practice some questions, exam standard question, like how this data will be tested. So here we go, guys. Please remember, first question I'm going to show you on screen. Questions are not easy. It's a little bit tricky. So here we go. Question number 1. So first, we are calculating here the break-even point in units. Okay. What is the question? Break-even point in unit increases when unit cost, what it is. Let's understand the question. First, remember how you calculate break-even point in units. Write the formula always. Break-even point in units means we'll take total fixed cost divided by unit contribution margin. Unit contribution margin, how you get? You need unit selling price minus unit variable cost, right? So this will give you unit contribution margin. Now remember, so our break-even point in unit will increase, like this answer, break-even point in units will increase. There are two possibilities. First possibility is what? Okay, I'm telling you, first possibility is what? If your fixed cost will increase. This is numerator. If numerator will increase, obviously the answer will increase. Or if denominator will decrease, so answer will increase, break-even point in unit. Okay, it will increase. So it means the question is the break-even point in units increases, like when this answer, break-even point in units increases. When? The question is about when unit cost, about only unit cost. Obviously, guys, so your break-even point in units will increase only, okay, if fixed cost will increase or unit contribution margin decreases. In that scenario, only break-even point in units increases. And in unit contribution margin, when it can decrease, there are two possibilities. Either if selling price increases or variable cost decreases. Is it true or no? Because unit contribution margin, when it will decrease, no, I said in different way. Unit contribution margin, it will decrease if selling price decreases or variable cost increases. Right? The question is about, so if unit cost obviously increases, then what will happen? Unit contribution margin will decrease and this will increase your break-even point. So actually this is the answer, because question is about very specific about unit cost. Obviously when unit cost increases, variable cost increases, it will decrease your unit contribution margin and which will increase your break-even point. So option A is correct. So unit cost increases and we assume here sale prices remain unchanged. Okay. And second scenario, if unit cost decreases, no, it's not option, because if unit cost will decrease, so contribution margin will increase and break-even point will decrease then. This is also not the option. So if unit cost remains unchanged, no, unit cost has to change. Or if unit cost decreases, not decreases. So unit cost should increase and sale price remains unchanged. In that scenario, your break-even points in unit, it will increase. So option A is the correct answer. Then we have a question number 2. Here we have another question. So here we go. They are telling you, for example, Delphi company has developed a new product that will be marketed for the first time during the next fiscal year. Although the marketing department estimates that 35,000 units could be sold. This is the estimated sale at $36 per unit. This is the selling price. This we need actually in the break-even point. Delphi's management has allocated only enough manufacturing capacity to produce a maximum of 25,000 units of the new product. So this is the production capacity is given. The fixed cost associated with the new product are budgeted at 450,000. This is fixed cost. And we need fixed cost. For the year, which includes 60,000 for depreciation. No problem, because fixed cost may include rent, insurance, depreciation, whatever operational fixed cost is there. Okay. Then this is the relevant information. Then they are telling you here data associated with each unit of product are presented as follow. Delphi is subject to 40% income tax rate. This is the tax rate 40%. So here if you look at there, so they are provided with you material cost, it is variable cost, $0.7, $7. Labor cost also variable cost, $3.5. Manufacturing overhead, it's also variable cost. Reason because this is variable manufacturing cost, is it? So it means this is all are variable. If I'll add these three, this is variable production cost. Then we have a selling expense, $1.5. I'm assuming it is also variable. Why I'm assuming? Because here he told you total variable cost. When he made the total of all, he got 16. Total of all what? All cost here 7 plus 3.5 plus 4 plus 1.5. So it is going to be 16. So it includes production and non-production, both variable cost. So what is the question here? Question is, you have to calculate the number of units of new product that Delphi company must sell during next fiscal year in order to break even. Question is about units. So it means you have to calculate break even point in units. And how would you calculate, guys? So simply you will take what? What you will take? You will take fixed cost divided by unit contribution margin. Fixed cost is given here for 50,000. I'll take 450,000. And unit contribution margin, I have to calculate. How? I'll take unit selling price, which is given here, 36, minus unit variable cost is 16. So 36 minus 16 is 20. This is your unit contribution margin. 450,000 divided by 20. Okay, you will get here answer. What is going to be your answer? If you will divide just, so you will get the answer, and answer is going to be, sorry. If you will just divide, so answer is going to be 22,500. Okay, so C option will be correct option. We have another question now. For example, this is a little bit tricky question, and it is really important to understand. So here we have a question, what? Which of the following would decrease unit contribution margin? Okay, the most, there are 4 options. Which is the most probable that unit contribution margin will decrease. So let me tell you here, unit contribution margin, how we calculate. We always take, to calculate unit contribution margin, we always need unit selling price. We need unit variable cost. So question is how your unit contribution margin can decrease. There are two possibilities. Number one, either if your sale price would decrease or your variable cost would increase. If selling price is decreasing or the variable cost is increasing, so it can decrease your unit contribution margin. It can decrease. Okay, so let's have a look at the option now. We are saying the most, like the most option is what? A 15% decrease in selling price. Yes, we understood that if sale price will decrease, unit contribution margin will decrease. So it looks true. Okay, what is next option? A 15% increase in variable expense. What is this? So if variable cost will increase, again, it will reduce the unit contribution margin. Now I'm confused which option is correct. Please remember, guys, we'll prove this. So actually option A is correct because decrease in selling price is always having a greater impact in in declining the unit contribution margin rather than variable cost. Okay, it looks both are correct, but option A is the most authentic reason that decrease in selling price. Let's prove it. How? So here we go. We can assume the data, guys, here. For example, this is our original assumed data. Unit contribution margin is equal to selling price minus variable cost. I'm assuming my selling price is 100 and variable cost is 50. So my unit contribution margin is 50. Okay, great. Now let's decrease first. Decrease first. First, I'm lowering the selling price because there are two possibilities. I'll reduce the selling price or if I'll increase the variable cost. Both would result in reduction in the contribution margin, unit contribution margin. Okay, but let's prove it. So this is my original data. This is my original data. My original contribution is 50. So let's decrease first selling price by 15%. So for example, what I'll do now, I'll take selling price multiply by 0.85% because I always assume selling price equal to 100%. If I want to reduce by 15%, what I'll do, I'll take selling price multiply by 85% because 100 minus 15 is 85. So it will automatically reduce your selling price with 15%. So my selling price was 100. If I'll multiply 100 with 0.85, so this is going to give you 85 selling price. And here I'm leaving my variable cost unchanged 50. So 85 minus 50, look, my contribution is 35. Now, second scenario I'm going to apply. What if I'll increase the variable cost by 15%? If I'll increase it. So let's do it. Now I'll unchange my selling price. I'll keep my selling price same as 100. But I'm going to just increase my variable cost by 15%. My original variable cost was 15. So if I'll increase by 15%, so what I'll do, I'll take $50 multiplied by 1 plus increase. So increase is 15%, which is 1.5, 0.15. So 1 plus 0.15, it is going to be 1.15 multiplied by 50. If I multiply, it will give you 57.50. So now it means if my selling price is 100 and unit variable cost is increased by 15%, okay, so it is going to be 57.5. So this is going to give you what? Contribution margin is 42.5. See, your original contribution was 50 here. And here, if you lower the selling price, contribution margin is 35. But if you increase the variable cost, contribution margin is 42.5. It means which is the most authentic reason to decrease your contribution. The authentic reason is lower selling price because here contribution is reduced by 15, but here contribution is reduced by 7.5 only. Okay, so that is why selling price, decrease in selling price is the most authentic reason. Okay, it has major impact. So it means option A is correct. 15% decrease in selling price. Understood? I hope so it is clear. So let's practice. One more question. Okay, now here guys, let's assume they're saying a manufacturer contemplates a change in technology that would reduce, like actually you are going to maybe replace old technology with the new technology. And what would be the result? So that would reduce fixed cost from 800,000 to 700,000. It means this is your old fixed cost. And after bringing the new technology, your new fixed cost is going to be 700,000. Okay, great. Then what? However, the ratio of variable cost to sales, write it here, sales less variable cost. This is called contribution margin ratio. If I'll assume sale is 100%. Okay, here he told you ratio of variable cost, he told you. will increase from 68 to 80. So it means here ratio of variable cost to sale. It means here variable cost is 68%. It means your contribution margin ratio was 32%. In second scenario, if sale is 100, because variable cost to sale ratio is going to increase from 68 to 80. In second scenario, if sale is 100% and my variable cost ratio is going to be 80%, it means my contribution margin ratio is going to be 20% in second scenario. So they are saying what? What is the question? They are saying if your fixed cost is shifting from 800 to 700 and your variable cost to sale ratio is going to shift from 68 to 80, or we can say the contribution margin ratio is going to shift from 32 to 20%. This is the same thing. Okay, what will happen to the break-even point in revenues? So it means here I have to calculate break-even point. So how I'll calculate? First, I'll calculate break-even point first by using old data, my old fixed cost divided by old contribution margin ratio. So I'm using your old data. Old fixed cost was 800,000 in the question, and old contribution margin ratio was 32%. So 32% means that you have to write 0.32. So I'll get here one answer. If I'll divide maybe 800 divided by 0.32, it is going to be 2.5 million. It is going to be $2.5 million. Now I can calculate the new also. New. How I can calculate new? I'll take new fixed cost. New fixed cost is going to be 700,000 given the question. A new contribution margin ratio is 20%, so 0.2. If I'll divide, so what answer I'll get? I'll get this answer, which is going to be 3.5 million. Okay, 3.5 million. Now look, in both scenario, your break-even point in dollar. Question is what? The break-even point in revenue or in dollar. It has increased or decreased? It has increased. Because in old it was 2.5 million. In new option, it will be 3.5 million. It means it is going to increase by $1 million. So which is the answer? This D option is going to be correct. It is going to increase by 1 million. Understood? I hope so it is clear.